Hey, everybody, welcome back. This week, Paul and I are going to dive into one of the most common questions out there in the infinite banking sphere, which is, hey, Paul, how much do I need to get started with infinite banking?
I don't know. How much money do you make?
That's a good starting question.
Right. We don't know, right? So it's going to require you, client, prospective client, to answer some questions for us. We need to know your income level, your expenses, and things that we need to know your cash flow situation. But ultimately, our opinion, I don't think you can pay enough premium.
Right. So we'll cover a few questions that you might want to chew on, and then come back to us with a good idea of, hey, Paul, how much can I pay to get started?
Now that's the right question.
Hey, I'm Dave.
And I'm Paul.
And this is the Wealth Warehouse Podcast. All right. Well, Paul, how's it going, man? You're looking a little scruffy. That retirement is treating you well.
Yeah, I need to shave for sure. Yeah. And I've got a new hairdo.
We talk about hair way too much on this podcast.
Really just growing it out a little bit just to annoy Tammy because she hates it.
Yeah, I think you need to get some of that. I've been seeing ads for Johnny Slicks, who's a veteran-owned like hair product company or something. Get some of that.
I could do
grease it back and look like a real life insurance salesman.
Right.
Yeah. That'd be awesome. Well, cool, man. I just had my second to last full drill.
Oh, that's awesome.
I know. I got one more drill weekend next month, and then retire in June on the first day of drill and never go back.
It's such a good feeling.
Yeah, I can't wait. I'll be joining.
It really is. In fact, my client I was talking to earlier today, I've known her about 19 years. We met in 2000. Oh no, maybe 18 years. We met in 2007 in Iraq, and I know her husband too. But anyway, she retired on the same day that I did, so we were just kind of like reminiscing a little bit. We made it. It's nice.
Yeah, that's cool. Very cool. Yeah. Well, so what's been going on lately? I think we let's share with anybody what's been going on with any clients we've been working with. So
sure.
You got anything that's come up recently that maybe people can learn something from?
Yeah, this has come up a few times now, and it's come up a few times in the last 5 years, but it's also come up a few times recently, and that is what you and I came up with as capitalization remorse. So another way to think about it, folks, is it's kind of like premium remorse. And what I mean by this is that people, despite my telling them in the process, hey, given your income level, this premium is a bit small. It's a bit anemic. And they're like, yeah, I'm just kind of dipping my toe in, whatever. And of course, 6 months later, they're like, hey, my premium is too small.
Yeah.
And I get to say, I told you
so. Yep. So
in a good way, though.
Capitalization remorse.
Yes.
Right. I'm happy to write another policy for you, but could have been more advantageous to just do this right the first time or go big the first time. Not that you're doing anything wrong. I mean, you did it right. You set up what you thought you could manage, and then you quickly realize you're capable of more. And sometimes that's what it takes. It takes some time of somebody just jumping in, doing it, and saying, okay, now I know I can do more.
Yes. And again, this is a new way to think for most people, right? And they don't know anybody outside of you and me who they've been talking to about the infinite banking concept that is paying high premium relative to their income. They don't know anybody else doing it, even though we know literally thousands of people doing it, right?
Yeah. And even if they did know somebody doing it, that person may be a little gun shy of telling them how much money they're putting into whole life premium.
Yeah.
Because people look at you really weird. Wait, you're putting 20, 30, 50,000 a year into this? What's wrong with you?
Right.
Yeah.
Well, Uncle Bob, he didn't know everything.
Right. So I've experienced the same thing. Actually, we're going to preempt capitalization remorse with somebody I'm working with, having this discussion on premium. What's the right amount? And as you and I like to do, we like to get somebody approved for what the company will allow them to do. You know,
Right.
what's the most the company will allow? And then we can work down from there, but at least we have that number approved. And that's a number I showed, and they had a different number in mind that was lower than that. And then they started thinking, we started having conversation and start looking at their income. You've got maybe your base salary, what you know you're going to get every single month at a minimum. So that could help support the minimum required premium, the base premium. And then a lot of people, especially a lot of pilots, have kind of soft pay where they may pick up a trip, or they get they get per diem, or they save that per diem up. They don't count it as part of their normal income, but
Smart.
it's extra income. You get maybe profit sharing, a bonus, a new contract structure coming up in the next year that you're going to get a new contract, a pay raise, and maybe some back pay. So really, at the end of the day, this client summarized to me, they said, well, I guess the big picture here is that, or the bottom line really, is if I'm going to err too big or too small on the premium, it's better to err too big because that PUA is not required to be paid. And that's kind of the slop room you have. So some years, maybe you don't max it out. Some years you do. And maybe you have enough to go back and make up for what you didn't do the year before. But it's, and I agreed, because that is going to prevent premium or capitalization remorse. Like, I didn't capitalize big enough.
Yeah, I agree. I think it's a good way to look at it. And I had that conversation last year with one of my clients, and I was like, listen, if you're this number, your base premium plus the fee for the PUA rider, that's your, if you're super comfortable, right, based on your income level with this number, and then this number you're also comfortable with, but it might be a stretch. You might just have to dial in your discipline a little bit more now that you're wanting to capitalize these policies. But let's face it, on most of the policies we design for IBC, there's 30, 40, 50, 60% of the total scheduled premium that is likely PUA.
Yeah,
And
right.
therefore not required, right? You want to pay it, you should endeavor to pay it, but it's not, if you can't get it all in there right on the anniversary, you can put it in there throughout the year at your leisure, which is nice.
And you're also kind of building room for future increases in income. So some people have a job where they're in a position to receive pretty regular pay bumps. Whether you're flying for the airlines, you hit year 2, year 3, year 4, or you upgrade to captain, or you're a teacher and you hit certain years, you get a pay raise. You're building in room in your policy to accept future increases, future influx.
Yeah, so
It's already earmarked.
No doubt. And, we work with a lot of military clients typically as well. And they get pay raises every 2 years. And then they get, as they get promoted, they also get raises. So sometimes there's 2 raises in 1 year. But I have a meeting with a young second lieutenant whose father is a client of mine. And this is actually the second policy on him. But we were talking last week, and I was like, when you're my age, 20-something years from now, and you're a lieutenant colonel, or maybe even a colonel, if you're still in the military, your pay is going to be many times what it is now. It's going to be triple.
Yeah.
Right? It's going to be triple what it is now. So that premium you're paying now as a second lieutenant is going to seem it's going to seem tiny to you 20 years down the road. Obviously due to inflation, which we shouldn't really celebrate, but it's a fact of life, right? So yeah.
Right. It does get easier every year. So that kind of leads us to a question that we hear quite a bit, and Luckily, not as often as we may be used to, because I think people are coming in better educated. But that question is, Paul, how much do I need to get started with infinite banking? That seems to be one of the most searched Google questions regarding the infinite banking concept is, how much do I need to get started? So how would you respond to that one?
Well, there's several ways, I suppose. Lately, I've been getting the question, how much is this going to cost? And I think we've addressed that a few times. I think that's the wrong approach. But how much do you need to get started? It's going to depend on how much you have. So that might be a question I ask right out, like, well, how much are we working with? What is your income? That's a good place to start the conversation. Like, okay, well, how about at least 10% of that income? Might be a good place for me to recommend for you to start at. Other clients that are in your income level, in your position, married with children, are generally paying this much premium. So that's kind of how I think I would get the conversation started. But it really depends. Like, you want a big family banking system, or do you want a small family banking system?
Yeah, right. And that question is typically an indication that somebody hasn't done enough education, and maybe they need to rethink their thinking, or read the book a first time, or maybe a second time if they have read it once. Reading Becoming Your Own Banker. So there's a lot of questions I would ask back to somebody to help them figure out that number, at least that general ballpark number on their own. How about what percentage of your portfolio is outside of your control right now? So the money you're putting away for a rainy day or passive income years or retirement, whatever you want to call it, what percentage of that is outside of your control and your reach? You can't access it without getting hit with penalties or taxes.
Yeah, that's a good one. Personally, right now, I just thought of this. I'm roughly 50-50 now.
On how you
money I
divide
can
your
control.
portfolio?
Yeah, and money I can't get to.
Oh, because you spent years and years and years funding your TSP.
Correct.
Right? Your government 401k or your
two TSPs,
roughly.
2 Roth IRAs, and I have a SEP that I contributed to for 1 year, just because the first year I was like, I'm gonna have a tax problem, and but now, yeah, I'm getting close to, I think, roughly 50% of the available capital I can get to.
Okay, good. I don't think many people can say that.
Right.
Yeah.
Right. The typical American can get to almost nothing.
Right. So how about this one? How big of a tax-free retirement bucket do you want, Paul? When you get to retirement and, you don't know exactly when that's going to be, you could say 65. Some people do it before. Some people, they got to work longer. So you don't know exactly when. You don't really know what the tax rates are going to be at that time. If we're talking 20 years into the future, you don't know what tax bracket you're going to be in. You don't know the cost of living, how much you're going to need. There's a whole lot of variables you don't know. How much of the money that you're counting on, which you only need one thing to retire, right? We talked about this before, income.
Yeah.
How much of your income during your retirement do you want to be tax-free income?
As much as possible.
Okay. So what are you doing about that today? Would be a follow-up.
Right.
I think most people would say as much as possible. Okay, well, what are you doing about it?
Well, they'd probably say, well, I was contributing to a Roth, but now I make too much money, and I could do the backdoor thing, but I don't want to do that now that I've discovered this. That's a real conversation that we typically have. Like, why? People, I don't know. We're not qualified plan guys. We haven't been for a long time, so it's tough for me to kind of play devil's advocate and be like, let me put myself in their shoes and be like, yes, let me put $7,000 a year into a Roth where I could put it over here, where I could get to a large chunk of it 2 weeks after I pay a premium.
Yeah.
It's anyway. So, no, I think you want as much tax-free passive income sources as you can possibly have.
Yeah, I know I do. Right. Who wouldn't?
Like, why wouldn't you?
Yeah, why wouldn't you?
Yeah.
Yeah. So that doesn't mean, we recommend putting 100% of everything you can sock away into a policy. If you want to do that, plenty of people do. But you could also put it in to the market. You put it into growth somewhere else. But there needs to be some put away that's going to be tax-free, that's going to be guaranteed to be there when you need it.
Yes, we've addressed it before, right? This is a both and strategy, the infinite banking concept, I think, right?
Yeah.
It's just the sequence of your dollar matters. This is simply where our money goes first.
Right. So let's talk about those years before retirement, which we don't like to use the word retirement, passive income years.
Sure.
Between now and then, what's your need for capital? What are you going to need to finance over the next, say, 15 years or more,
Sure.
if you're younger than us, until you get to that point?
Well, people are going to finance cars. Some of you, heck, we know a guy that's owned like 90 cars. He's 50 years old.
Oh, I thought I was talking to him. How many of you own?
I have to count them up. Not that many. Not even close.
Well, and his son, who was like 19, had owned like 20 cars or 30 or something.
It's crazy.
Yeah.
But you're going to finance vehicles. You're going to finance vacations. You're going to finance investments. You're going to finance did I say education?
No.
Education, whether that's primary, secondary education, whatever it is, right? Again, 529, no bueno. So you're going to have a need. You're always going to have a need for finance. And, Nelson talks about in equipment financing, the guy did well just self-financing through whole life insurance, the things he was going to finance anyway, trucks in this case, equipment, right? And he did very well in those examples. So yeah, you're going to finance, add up all the interest you've sent to other people's financing institutions. And it's tens of thousands, if not hundreds of thousands of dollars by the time you're in your 40s, probably.
Right. Because at the end of the day, infinite banking is really about financing the things of life. How do you finance the things of life? And are you playing the banker in your own life, or is somebody else doing it?
Yeah, we sometimes, I think that gets lost. There's so much noise out there around IBC. And there shouldn't be. It's really quite simple, and I'm glad you said that, because I think recaging and just focusing on this is what we're trying to do. We're trying to create a family generational financing system using money we already have that already exists, and simply just by redirecting it towards life insurance premiums instead of whatever else it was going to go do. Some people just stick it in a savings account.
Yeah. And we work with plenty of people who've been saving up for a few years, and they're like, I got a lot of cash sitting in the account. Now I got to figure out a better place to put it.
A better place to put it. That's right.
Yeah.
Far better.
Yeah, far better over the course of your lifetime. So what if you had, so we're recording this, early April, at the end of March, late March, or actually early April. So I guess call it a couple weeks ago, if you had retired then, right before the stock market, according to the media, when you get on and search media, the stock market crashed. It lost $11 trillion in a single day, hatchet job, like bloodbath, right? In reality, it dropped about 10% from, its high within the last month or so.
Sure.
So really, in the grand scheme of things, not that big a deal. Just zoom out, look at a 5-year graph. You're still ahead from where you were a year and a half ago on there. So anyway, but if that's the only money you have in your entire life, and you're expecting that's your income, your source of income, your sole source of income in retirement. If you had just retired and that happened, how's that going to affect your financial life? How's it going to affect your emotional life?
It's going to hurt.
It's going to hurt. It's going to hurt pretty bad.
Yeah, there's going to be some angst for sure. And you got to go to your advisor and be like, what happened? But And of course, he should be, preparing you for this depending on where you are in your journey. If you're in your 40s, you've got some time to kind of respond and to recover, right? It's a paper loss. You're not taking the money out anyway, hopefully,
Right.
to use, especially if it's in a qualified plan. You're not. But if you're 65, 70, 75, 80, whatever, and you're still in a higher risk portfolio structure, that's probably not where you want to be.
Yeah.
Well, it's obviously not where you should be, right? I think some financial advisors, I'm sure they would tell us, yeah, we agree with that.
Right.
Depending on what someone's personal situation is, you don't want to be in a high risk portfolio.
Yeah, you need to preserve capital.
No doubt, especially because you don't have time to recover. You're 80, you're 70, you're living off this money. And we've talked about sequence of returns risk and how something like this, where it goes down 10%, 20%, 30% maybe, that you don't want that, right?
Right.
You need this to counteract that.
Right. So if you were retired, let's say fast forward, 20 years, and you and I are at that age where we're only working on taking passive income, and we had a large stock portfolio and it dropped 10%, what are we going to do? Are we going to take money out of our 401k at that point?
No, I wouldn't. No, we're not going to need to, because we have this other asset class, that's guaranteed, that's liquid, that I can draw from until such time that portfolio over here that it recovers.
Yeah. So how much did your cash value lose in the last market drop?
It's not market correlated, so I didn't lose anything.
Right. It went up actually.
It goes up every day. It's going up right now.
Yep. As we speak, I'm making money. My money is making money as I speak. So yeah, right. We didn't lose anything. It actually went up from the previous day.
Yeah,
So
and
my buddies are texting me about the market.
Yeah,
I'm like, I haven't even looked because
I have no angst whatsoever.
I've got no concerns.
No concerns. And if we wanted to, right, I could, people want to say buy the dip, right? And of course, you don't know how deep this dip is going to go.
Right.
Where does it end? Where's the bottom? We have no idea. You have no idea. I'm sure Nancy Pelosi might know. You could follow her stock picks and what she's doing.
Well, all of them might know. I mean, Dan Crenshaw even knows.
Yeah.
So, yeah.
But, it's one of those things where I think part of living the IBC way of life is like, it's very peaceful. And we have clients that have money in the stock market. Some do, some don't. Some do other things with their money. Some are real estate moguls. Some are just in private practice and they make money doing that. So, and everything in between. But I don't have any FOMO of, I got to buy this dip. I could. With some money, I could go buy a chunk of an S&P 500 index fund and buy this 10% dip, and then maybe it recovers within a year or an unknown amount of time. To be honest with you, because let's face it, we were kind of due for a serious correction. All this money, the trillions of dollars that have flooded the economy, money that was printed, lent to the Treasury, given to the taxpayer in some form, right? I think we've been riding that wave for years now, and it's just it's artificial.
On the emotional side, as you mentioned, the longer I'm doing this, the more peace of mind I have, and
Absolutely.
the more capital I've accumulated, the more capital I now control. Whereas if I was only focused on my market returns, the longer I'm in, really the less peace I have. Because if you had $1 million portfolio in the market, you just lost $100,000.
Right.
That's a lot of money.
Yes.
Like that hurts. If you had, $1,000, oh, you lost $100. Okay, no big deal.
Right.
If you have $1 million, you lost $100,000. If you have $3 million, you lost $300,000. Like that
It's
hurts.
not insignificant. Yeah.
It's not. And even and the human mind, I don't know, the human psyche, you can't not think about that. Like, oh my gosh, what could I have done with that $300,000? That was 3 years or 2 years worth of retirement right there. I just lost 2 years of my retirement gone overnight.
Right.
Like it becomes more and more, I would think, I can't speak from experience because I'm not there, but I would think it would only become more and more stressful the older you get, where you've accumulated more, but you have more to lose too with any percentage of a market dip.
Absolutely. And I think folks, if you're considering becoming your own banker, embracing the concept of IBC and paying significant premium relative to your income, you really need to think about with the end in mind. You really need to, like, you can say right now, hey, we're financially savvy, we don't have any debts, we live within our means, we max out our 401ks, or we get or we do enough to get the match. Whatever you're doing, and you're doing fine, that's great. But the future is unknown. The market doesn't go up forever. Your health isn't always going to be awesome. There are just so many unknown things. Think about your own family and the things that have happened in it, whether it's your cousins, nieces, nephews, grandkids, sisters, brothers, whatever it is. Something has likely occurred to somebody that greatly affected their future financial picture. And the question that families never seem to, they just glaze over it. And maybe I'm talking, too close to home, but it's just like, okay, what are we doing to prepare for the next emergency, the next
Right.
unknown? Likely nothing.
Yeah. And the fact is, you have a duty and a responsibility to prepare for that. Don't
Yes.
be expecting somebody else to come to your rescue or the government to come to your rescue. It's our duty as parents to plan for that and be ready for it, so that we don't have to negatively impact our children when that inevitably happens in the future. Like, who hasn't dealt with something in their family regarding cancer or medical scare, a job loss, even bankruptcy, divorce, a special needs child, or a child with on the spectrum who's going to need long-term care, like all kinds of stuff.
Those are all very, very real and stuff that happens, literally all the time.
The chances are probably better of something like that happening in your life than it not happening. Right?
Yeah, I would say
If I
the
was a
odds are
betting
likely.
man.
Yeah, the odds are higher that something's going to happen are higher than someone actually is going to capitalize properly in whole life policies. Like,
Yeah.
you know what I mean? Like,
Yeah. But along that same question is that I would ask somebody when they're asking, how much do I need to get started? Well, how much money do you want your family to have should you graduate tomorrow? Should you leave this earth tomorrow? How much money do you want your family to have? Do you want
as
them
much
to
as
have,
possible.
Exactly. Nobody would say anything different.
They always say like a number, I think. Like, $1 million. I don't know.
Like, really? Is that
And-
what you would wish for? Or would you wish for it as much as possible?
Right. The right answer is as much as possible. It might be $1 million. It might be 10 million.
Yeah.
But there shouldn't be this artificial limit on it. Like, I know, folks out there, we've got $500,000 of death benefit, in the SGLI for the military, for example.
Yeah.
And we run into people all the time, military officers, colonels, lieutenant colonels, whatever. That's all they have. And I'm like, have you ever really unpacked? I hate saying that. Have you ever thought, like, how long that's going to last your family of 3 after you're gone?
Yeah.
500K. It's going to last 5 years. Maybe.
Maybe. I mean, these days, especially if it's a lieutenant colonel, they make decent income.
Yeah, they make about 140,000 a year,
Yeah.
probably. Ish.
So,
Give or take. Depending on where you
yeah.
are stationed BAH-wise and stuff.
right. So, yeah, good point. So that's a good thing for people to think about. That sounds like a really big number, because in a lump sum, it is a big number. But if that's a number that's supposed to support your family for the next how many years? 10, 20, 30? I don't know. How many years did you plan on working? another 20 years after you retired from the military? Probably.
Probably. Yep.
Is that enough to support them for the next 20 years and build up enough with that money over the next 20 years to have it last them another 20?
No.
You know?
It's not even close.
Right.
It's not even
So the answer is as much as I want, as much as possible.
Yeah. And I think people just need to just take a moment and really critically think about this, about what Dave and I just talked about. Just give it a simple thought. It doesn't take higher level calculus to figure out that ain't enough. And if we've said it before, if IBC isn't your thing and whatever, by gosh, go get yourself some convertible term, and a lot of it. It's relatively cheap.
Yeah. But you can convert it should the worst case happen, or you're not where you thought you would be 10 or 20 years from now. You can convert that to a whole life policy.
That's right. And we run into people all the time that want this and they can't have it, at least on their own life, right? Because of medical reasons or whatever. And between the two of us, we have over 100 people that have been denied insurance for one reason or another.
It's more common than people think.
Yeah, it's not uncommon, that's for sure.
Right.
Yeah, that's for sure. So
that's true. So to wrap it up, I guess go back to what you said at the very beginning. We think it's all relative to your income. How much do you need to get started? Well, it's how much do you make? And then for Paul and I think at a minimum, you want to start with 10%. If you're going less than 10%, if you're going single digits of your income as premium, the fact is you're afraid to capitalize.
Correct.
And
looking at it as a cost.
Book again. You're looking at it as a cost as opposed to capitalizing your system and taking over the banking function in your life. So I would say at a minimum 10. And if you want to talk generalities, I think most of our clients do somewhere from 15 to 20% of their income.
I think people are asking that question, Dave, like how much does this cost? Because they're thinking in terms of death benefit. I need $1 million death benefit. That's what they have in their mind. So they do want to know how much premium it's going to take to get to that level. But from the IBC perspective, right, we look at it as a completely different thing. How much premium? What's your premium paying ability? We can get you to $1 million.
Yeah, that's easy.
That's easy. The premium paying ability and the capitalization of the policy or policies is what's more important. The idea of controlling the function of banking in your life is ultimately more important. If you want $1 million of death benefit, that's easy.
Yeah.
If you can qualify for it medically, great. We'll get it for you. Easy. We'll get you $2 million, get you $3 million. As long as you can qualify.
And anybody
for it
can do that for you. You could call any random insurance agent who's a 19-year-old kid who just got a license, doesn't know up from down. He can get you $1 million in death benefit. So
correct.
If that's all you're looking for, easy. But if you're looking to take over the banking function in your life and finance the things of life and recycle your money, reuse those funds over and over and over, and build that tax-free retirement bucket that you can pull tax-free income from in retirement to offset, say, a down market like we just experienced during those periods, then you're going to want to talk to somebody like us.
Yeah, no doubt. And gosh, I'm glad you sent me that book all those years ago.
You're welcome. No, you can take me out for a steak dinner next time I see you.
I'll have Brian take us out.
Actually, yeah, it's true. Actually, I'll be supplying your dinner next time I see you next month.
Right.
Or not
I
next
am
month,
coming.
in June. Okay, good deal.
I'm RSVPing right now.
All right, good deal. Coming to the retirement. All right. Well, I tell you what, I'll provide dinner and all the Kirkland signature booze you can drink.
Right on. That's Costco for those.
Because I'm a Costco member. Joined a pretty elite club recently.
Their Prosecco is very good.
Oh, really?
Yeah, all Prosecco is from Italy, but their Prosecco, they have 2 different Proseccos there, and it's actually very good. I bought a case of it last year.
Huh? Yeah. No, the wife likes Prosecco. I actually bought this old-fashioned mix from there.
Pretty good?
Yeah. I mean, the bottle of maraschino cherries, the high-quality ones, cost more than the actual entire liter of old fashioned mix. But yeah, put a cherry in there and an orange peel, stir it around.
Do you have a fancy ice cube maker?
I do. I've got, I've got the big square or a cube and then the spheres.
Yeah, the spheres are cool.
Yeah. So, yeah, man. Looking forward to it.
Okay, so sum up, bottom line, how much you need to get started? 10%. 10% of your gross income is where you should, that's your target.
That's your minimum. That's your minimum. I wouldn't call it your target. I'd say that's your minimum.
Minimum, yeah.
Right. All the way up to 20 to 30%.
Yeah, and to quote our friend, you can't pay enough whole life premium. Well, Paul, that's easy for you to say. Like, yes, but it's also true.
Yeah, premium is not to quote James or to misquoting perhaps. Premium isn't the problem; it's the solution.
That's right. The problem's the problem.
Yeah, the premium's the solution.
That's right.
Yeah. All right, everybody. Hope you enjoyed, and we will catch you back here next week. Until then, control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle in a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.